Hi there, welcome to Kneppy Invest. Time for my weekly portfolio and technical update. We'll be looking at the performance of three of my portfolios using slightly, or maybe not slightly, different strategies. And in the technical update part of this video, I'll be looking at some charts of companies that are looking a little bit interesting right now. A few companies that potentially I might take a trading position in. But first, let's have an update of the performance of three of my portfolios, starting with the long-term portfolio. This is using a strategy that would be defined as the traditional buy and hold strategy that most investors are taught. That's how you should invest. Look for some companies that you think are long-term holds that you want to own forever and buy those companies and don't sell them. And that is what I use in this particular strategy. Now, there is an argument that some of these companies may not fit within that strategy. For instance, I can think of one company, actually two companies, Nanosonics and Telix Pharmaceuticals. Now, the reason I've put those two companies in this particular portfolio is simply because I don't see myself selling out of those two companies for many, many years unless something goes drastically wrong. Now, however, in saying that, someone did send me an email about Telix Pharmaceuticals. This person from the United States, they say they are an expert in that field, and what Telix Pharmaceuticals are selling is nothing too special. And I do believe you have to look at all sides of stories, including bear cases for companies you're owning and bull cases for companies you want to short. So I did actually read that email fairly closely. And a lot of the stuff that he said did go over my head, but it does make you think when you read an opinion about a company you own and you think you're going to own for the long term that is counter to your own opinion. So maybe I did learn something just by reading that particular email. Now, I also have companies that I own on foreign exchanges or international exchanges, so including Denmark, Germany, NASDAQ, and New York Stock Exchange. Best performing companies at this point in this portfolio are Pro Medicus and Nick Scali. This is from the start of the financial year, by the way. Now, these aren't the best performing companies in this portfolio overall, but since the start of the financial year, Pro Medicus is up 33.7%, Nick Scali up 32.8%, and third on the list is Adobe up 26.1%. A few other companies up above 20%, Breville and PWR Holdings, while the worst performing company in my portfolio, or this portfolio, is actually Telix Pharmaceuticals, down 16.3%. Overall, this portfolio is up 3.5%, which includes capital gain, dividends, and currency gain. And compared to the benchmark, and the benchmark I use for this portfolio is the STW, or the ASX 200 fund, and that is up 0.3%. And the main reason I want to compare the performance of my portfolios to benchmark is because if you can't beat the benchmark, in fact, if you perform significantly worse than the benchmark, then you probably should just put your money into ETFs. I've been told quite often, why am I investing in individual companies? I should just put my money in ETFs and forget about it. The whole reason I buy individual companies is because I believe I can beat the market, and not only beat the market, significantly beat the market. And if I can significantly beat the market, why would I put my money into ETFs? And the other thing is, I love doing this sort of thing. I just love it. So if I love doing it, then why not keep doing it, particularly if I can beat the market? Onto my second portfolio, which is the medium-term portfolio. This is probably using a strategy that I favor the most, finding smaller companies, much smaller companies than I have in my long-term portfolio, and particularly finding small companies that have the ability or the potential to grow significantly in the future. And just by looking at the performance of this portfolio, and this was a stunning week, by the way, up 9.4%. And I'm comparing this portfolio to a different benchmark. This is the small cap ordinaries, which is down 3.1%. So the reason I want to compare to the small ords is simply because I typically invest in small cap companies, and those small cap companies are in this portfolio. Now, not all my investments within this portfolio do well. And the other thing I should mention is I have a lot of holdings in this portfolio. So those who say you should only own 20, 25 companies, I don't follow that. The reason I don't follow that is because when someone says that, they're assuming you're only buying the biggest companies in the world or in Australia. You're only looking at the ASX, maybe 50 or 100, and you're picking 20 companies out of that, and that's what you're investing in. The vast majority of these companies in this portfolio, if not every single company in this portfolio, is much smaller than those large cap companies. I probably would say there might be a few companies here that have a market cap above $1 billion, but most of them are fairly small. In fact, some of these companies have a market cap, say, less than maybe $20 million. Now, this was a great week for this portfolio, up 9.4%. Last week, it was only up 5.7%. So an absolutely stellar week. And the best performing company in this portfolio is Findi. I did do a video on this company last week, and that currently is up 209%. And that's the main reason I like these small cap companies, because they can go on runs like Findi, which the bigger companies more than likely won't. Now, on the flip side, a lot of these small cap companies can go on a negative run. And you'll see the worst performing companies in this portfolio are performing significantly worse than the worst performing companies in the long-term portfolio. However, just look at these best performing companies, significantly outperforming the best performing companies in the long-term portfolio. So not only Findi up 210%, Energy One 91.5%. That's a whole different story, because I did sell out of Energy One because of takeover bid, and I bought back in when that takeover bid fell through. EOR Payment 72%, Doug 64.4%, Ordinate 60.4%, and I am thinking of putting Ordinate into my long-term portfolio, because this is another company just like Telix and Nanosonics that more than likely I won't sell. I have a hard time finding a reason where I will sell out of Ordinate, and that is the sort of company that I think will become high quality in the future. That's the other thing I should mention. In my long-term portfolio, they should be high quality companies. In this portfolio, we're talking about small cap companies that have the potential to become high quality companies in the future. So Ordinate and Serata, 57.9%, Stealth Global, for some reason, went on a really big run, 54.5%. In fact, I'm going to put Stealth Global onto the technical part of this video because the chart looks pretty interesting. So Stealth Global up 54.6, then Chrysos Corp up 40.7, Viasat 40.4, Alice Pearl 36.2, Bladeside Studios 31%. So we're seeing a lot of companies significantly outperforming the best companies or best performing companies in the long term. But on the flip side, look at the worst performing companies performing significantly worse than the worst performing companies in the long term. But we don't have many really bad performing companies. Pointera, Vection Technologies, Botura, XREF had a big down day. Cydev, Rectify Technologies. The other thing you should also note is when you compare the worst performing companies to the best performing companies, you'll know by simple mathematics that the worst you can do with the worst performing companies is down 100% if they go bankrupt or something like that. The best you can do in the best performing companies is infinitely. So Findi is up 209%. And that's the reason why over time, if you can pick the right companies, and in this sort of strategy, because I have a lot of holdings, some of these companies are going to run hard, that eventually the winners should significantly outperform the losers, because the best returns you're going to get is 1,000%, 10,000%, while the worst performing companies, the worst they can do is down 100%. Now, if you are a fan of shorting, it's on the complete opposite. The worst you can go is infinitely so, and the best you can do is not much. That's why I don't really like shorting, because it's not, the odds are not on your side. You have to really know what you're doing. Anyway, so no, by the way, no purchases or sells in either of these portfolios. So much less active in the long-term, medium-term portfolio compared to the short-term portfolio, which at this point in time had been performing significantly better than the other two portfolios. But the medium-term portfolio is catching up the short-term. But still, short-term is the best performing portfolio. Now, in this strategy, or in this portfolio, I'm using a more of a trading strategy. And I'm willing to buy and hold companies for a very short period of time in this strategy just by looking at charts. And I did make one purchase in the week, and that was Elders. And I made a purchase of Elders for a couple of reasons. Maybe I'll have a look at the chart as well. But anyway, performance of this portfolio up 10.6%. compared to the benchmark, and I'm using the STW here, which is only up 0.3%. So significantly outperforming the market right now. So I'm very happy with the performance of this portfolio. However, I keep making mistakes. Now, I've talked about this in previous videos, and I want to clean up those mistakes by having in place some rules. And I want those rules in place by the 1st of January 2024, and I should do a video on that. And one of my rules is I don't want to be holding companies that are down by more than 10%. That should be my stop loss. Down 10%, sell, because then the whole reason I bought that company is no longer valid. And I'm still holding a couple of companies here which are down over 10%, including ResMed, which actually I'm more willing to hold. And more than likely, that's not a trading position because I do think ResMed is undervalued. I just don't want to sell that because I think it's undervalued. And the other company is Integrated Research. And that should be more in the medium-term portfolio as well, because I do think Integrated Research is a possible turnaround story, only possible at this stage. I don't think it looks as good as Gentrack, which is another company I own and have traded in them before and have now, in fact, let's have a look at the Gentrack chart as well. I'm not going to say Integrated Research will go down the same path as Gentrack, but it has the potential to be a turnaround story. So those are two companies that I probably should have sold, but maybe they don't belong in this portfolio. Best performing company, Step 1, has been very volatile over the past week. And then we have MA Offshore, and by the way, Step 1 is up 50%, MA Offshore up 17.8%, ServStream 14.7%, Digger Data 10%, email payments, which I am trading, 7.6%, and Hub 5.4%. So overall, happy with the performance of this portfolio. If you have any questions about the performance of these portfolios, the makeup of these portfolios, leave those in the comment section. Last week I did a comment, which I'm going to do a video on, a rant on. In this particular comment, someone mentioned that I have too many holdings or something, and I shouldn't be trading so much because I'm only giving money to the brokers. And I'm going to do a rant on that. And everyone's has a right to their own opinion, but I just don't like when people say, not like, I just think it's silly when people say you have too many holdings, because I don't abide by that silly notion that you should only have 20 to 25 holdings in your portfolio. Now onto the technical update, and we'll look at some. Actually, I'm going to pause it here for right now. Pause here. I'll put an ad here. So a lot of times YouTube put ads wherever they want to, but I'll put an ad here. Have a pause, have a break, go get a coffee or something like that, a drink, a Pepsi Max, and I'll be back in a second. Now onto the technical update part of the video. We'll be looking at a few indices, some commodities, maybe a bond or two, and then finish up with about 10 to 15 individual companies' charts, including many I don't own. In fact, I think every single company I'll be showing you in today's video, or every chart I'll be looking at, are companies I don't own, but I am or will be looking at. Oh, there is one or two. The last two I just added in the previous section, the portfolio update, Stealth Global and Gentrack. But all the other companies are companies I am following closely. A few of these companies I may, possibly make some purchases in the next few weeks, depending on what happens in the future. But first of all, let's have a look at the indices. XJO, nothing too exciting happening. However, there were a couple of two good days. I believe it was on Tuesday and Wednesday, where the XJO rallied nicely, 0.8% on Tuesday and also 1.4% on the Wednesday. And even though it went on a nice rally, this is not a bull market at all. It's just a nice little rally. And in fact, just look at this. This particular chart goes back to July of last year, and the XGO is still going sideways. So no trend in place right now, no uptrend, no downtrend. If you had to pick a trend, you'd probably say still in a short-term down trend. However, in saying that, it does look like the high we just saw a few days ago just slightly went above the previous highs we saw back in October. So maybe that's a good sign that the lower lows and the lower highs has come to an end. But I wouldn't say we're definitely going to get a Santa rally. I noticed a lot of people talking about Santa rally in podcasts over the past few weeks. But just because we're moving into that time of year doesn't mean or automatically mean we're going to get in or go into a Santa rally, because every single year when we don't have a Santa rally, people just forget about it. And when we do have a Santa rally, everyone says, oh, wow, we've just had a Santa rally. It doesn't happen every single year. And if it did, that would be ridiculous. And we could forecast that and get in the market big time if we thought that exactly what was going to happen. It's not going to happen, or may not happen. Anyway, small ordinary. So this is the XSO. This is a little bit more bearish than the XJO, simply because this is looking at small caps, and small caps are under way more pressure than medium, particularly large cap companies, because larger cap companies tend to be a little bit more defensive. Smaller cap companies, less defensive, because a lot of these companies are not profitable, burning through cash, and the market wants profitable companies right now. No reason behind that is because of interest rates. Interest rates decrease the value of future profits. And a small cap company where all their future profits are 5 to 10 years down the road, those future profits, or the value of those future profits, are significantly less in a higher interest rate environment. I'm pretty sure I've done a video or two about that. And the American small cap indices proxy sort of thing is the Russell 2000, which is looking at the lowest or the smallest 2,000 companies on the Russell 3000. Russell 3000 is all the companies in America, or the top 3,000 companies in America, New York Stock Exchange, and also the NASDAQ. So again, this is a proxy for small caps. In fact, it says here, TradingView, US Small Cap 2000, which is Russell 2000. Anyway, not quite as bullish as the XSO, but definitely way more, not as bearish as the XSO, but way more bearish than the NASDAQ. Let's have a look at the NASDAQ. And NASDAQ is almost at, not quite, the previous highs we saw back in July. Not all-time highs, because if you look at the weekly chart, back in late 2021, the NASDAQ did get above 16,500. But a nice little rally in the NASDAQ, particularly when it broke above this trend line, this downtrend line. As soon as it broke above that, we've seen a nice little rally. And I would say that the rally in the NASDAQ is because of those bigger companies on the NASDAQ, those Apples, maybe not Apple, but definitely Adobe's gone on a nice run, which is not the big seven. But I think Amazon, Microsoft have been on nice runs. Nvidia's are still up there. Dow Jones, which is, was it the 30? Not many companies in the Dow Jones. And I'm not even sure why I'm showing you this. Just like the XJO, this is just going sideways. No trend at all. In fact, even though in the XJO you could say there is a short-term downtrend, when you look at the Dow Jones, there's no trend at all. It's got a nice little rally, but no trend at all in the Dow Jones. And that's probably all I want to talk about when it comes to indices. Now let's have a look at some commodities, starting with the most bullish of the commodities, which is iron ore. Now, I'm pausing right now because I think that's wrong. I still think uranium is probably the most bullish out of all the commodities right now, all the commodities I can think of right now. And I'll show you the uranium chart in a second. But the most bullish, second most bullish maybe, of the commodities is iron ore. Not sure if this is a good thing or a bad thing. Maybe not a bad thing. I'm not sure if this is a good thing in regards to China, because everyone's saying, oh, China's in trouble, iron ore prices should collapse, and iron ore prices are actually looking really good. This chart looks really nice. Right now, iron ore is at the highs we saw back at the start of the year, particularly around March. And you can just see iron ore prices have just going sideways the last 3 or 4 trading days, because it's a technical signal that we're at the previous high back in March. So there's a little bit of resistance at these levels. So if iron ore can get to, say, we'll say 132 to 135, that would be a good sign moving forward for iron ore. I'll have a look at a couple iron ore companies, Fortescue and Fenix Resources, and you'll see a massive difference between these two individual companies. So it looks like all the money is going into those bigger iron ore companies like Fortescue, less so BHP and Rio. And right now, none of the iron ore money is coming, or the stock market money is coming into the smaller iron ore producers like Fenix, which may be an opportunity for us, retail investors, to take advantage of this disconnection between the bigger iron ore companies and the smaller ones. Just putting it out there. I'm thinking of doing that. Gold is definitely not bullish. wouldn't say it's bearish either, but we have seen iron ore or the gold prices start to turn around. If we see iron or gold, why do I keep wanting to say iron ore? If we see gold getting above and way above 2000, say 2020, 2040, that would be a good move. But again, a really strong, significant resistance level for gold is 2060. We need to see gold get above 2060. Why is that a significant level for gold? Look what price gold has had trouble getting above over the past, 3 years now. August 2020, gold, after a massive, beautiful run, got to 2060, pulled back. In March 2022, gold got to 2060 and pulled back. In April 2023, gold got to 2060 and pulled back. And the whole reason gold's pulling back at that level is just because trading. And as soon as gold gets at that level, we see increasing supply of gold. That sort, not gold, but people wanting to sell gold, that sort of thing. Maybe sell short. Uranium is the most bullish of the commodities and had a really good week. Look at that, up 5.8%, up to $78.20. This, I don't own any uranium companies right now, which is a mistake. I should have maintained my positions. I sold profits and then I should have just kept on holding. A little bit too impatient. So what can you say about uranium? Look at that. That's a beautiful looking chart. Onto US oil, up 4.36% on the Friday. Let's have a look at oil. So oil was looking pretty good from about June through to September. Now it's pulled back. Is this moving into a downtrend? It doesn't look really good. We had a good day on the Friday, but that means nothing. We need some further good days moving forward because it just bounced off another low. If it fell through $64, that would be very bearish. But then at that point in time, a lot of oil companies' share prices should be falling a fair bit, and we could take advantage of that possibly. I will be showing you one oil company, Karoon, in the video. I was thinking of taking a position in Karoon. There's a few things I want to talk about when it comes to Karoon. Now, how many times can I say Karoon in a video? So who knows? I can say Karoon as many times as I want. Nothing's holding me back. Bitcoin. Bitcoin looks pretty good. Looks pretty good. Going up to 36,551. My $2,000 worth of Bitcoin is now worth $2,500, something like that. I'm not complaining. And lithium. This is the complete reverse of uranium. Lithium is bearish. Keeps falling. I don't think I'm going to. I will be showing you one lithium company, Pilbara. I was thinking of including Alkium and a few others, but there's no reason why to get excited about lithium right now because lithium prices just keep on falling. You don't want to catch a falling knife, and this is a perfect example of a falling knife right now. We just don't know how far lithium prices could fall. They could drop half further from here. Did I say that right? They could drop another 50% from here. We just don't know when the bottom is going to come in. Copper, should I show you copper? It's pretty boring. Copper's boring. I do have a few copper plays potentially if I start to see the copper prices move into an uptrend. But at this point in time, I don't think I own any. I own one copper company, and that company is moving into production within the next year. I won't show you coal. Coal's pretty boring. I will show you the US 30-year bonds, and that has pulled back from its highs. It's gone from 5.1% down to 4.59%. Just because it's dropped a little bit doesn't mean anything. I've heard a lot in a few podcasts over the last few weeks how bond yields are dropping, and that's after it rose significantly over a short period of time. So this is just maybe a pullback. We just don't know at this point in time. The very fact that inflation was below expectations was a good sign, but we need to see that continue into the next few months, over the next 6 months. And unfortunately, Australia is complete opposite. Our inflation is a little bit higher than what we want and expected. Won't show you Australian 10-year because it's very similar to that. And the TLT won't show you that because that's the inverse of this chart. If you don't believe me, let's have a look at the TLT. That's the inverse. This is the 20-plus year Treasury Bond ETF. Maybe it has reached a bottom and maybe bond yields have reached a top. So they should be exactly inverse. The TLT ETF and the bonds. Now onto individual companies. So these are companies I'm maybe going to be following a little bit more closely than I probably usually will for potential buys. Now, more than likely, I will make maybe one purchase over the next few weeks of these companies. Just because I have put these onto my watch list or I'm following a little bit more closely doesn't necessarily mean I will buy. But some of these charts do look interesting. And the first company is Coventry Group. Whole reason I have started following Coventry Group a little bit closely is because share price was in a downtrend. Share prices look like they are turning. Now, this shares in this company can be liquidly traded, and you can tell that just by looking at the chart. I don't have to show you the amount traded each day, but just by looking at the chart, you can actually see shares in this company are liquidly traded. Now, the interesting thing about Coventry Group, it does look like maybe shift in sentiment, and the trend in the share price wants to become an uptrend. And coinciding with this shift in sentiment and trend in the share price is volume. Volume has increased over the past few months. And if we compare to, say, October, November last year, there was very little volume last October, November. And main reason behind that is because share price was in a downtrend. So some good volume coming in, which tells us that someone is interested in Coventry Group. Maybe some fund managers are interested in this company and they're maybe building their position, or they've started accumulating a new position in Coventry Group. So Coventry Group looks interesting. I don't even know if this company's released any announcements or anything like that. I have no idea, but someone likes this company. Markup 128 million. This company has a dividend yield 2.6%. Says price to earnings ratio 51.5. Maybe would ignore that. Have a close look at the company because that could be on depressed earnings last year, and maybe the market expects earnings to triple in 2024. I'm just saying possibly, doesn't mean they will. Now onto Pilbara. So why Pilbara? Well, Pilbara is at a really interesting support level, which is $3.40. We saw Pilbara get to $3.40 back in March of this year, and then went on a nice little rally. And right now, it's at those levels. So if Pilbara prices fell below $3.40, that would be sort of a bearish sign. So what you could do right now is buy Pilbara just above $3.40. Not assuming, maybe not hoping, but on the plan that we might see a rally in Pilbara's share price. And what would help that would be lithium prices going a rally. And then if the share price of Pilbara falls to well below 340, say to 320, that would be, say, a stop loss sell because that's a more bearish sign. And this support level, the support zone, has been broken. So that's the way you could play it. Doesn't mean I will play it, but that's just a way you can play it. Bigtincan. Now, this one saw massive volume coming in. Now, this company did release an announcement and business update on the 15th. And when the company did release a business update, share price rallied 9%. So obviously, the market initially liked something in the business update. And then the share price plunged the next 2 days. On Thursday, down 18.4% and down 12.5% on the Friday on huge volume. So either someone is completely offloading the shares in this company, or someone looked at the business update and went, we don't like what we're seeing here. This is the next 2 days. So it took a while for the business update to digest and then just sell en masse. Another way you could look at this, with the massive volume coming in, this could be capitulation. This could be a signal that the bottom in the share price for this company has been reached. A markup 106 million just keeps on falling. Now, this company wants to be free cash flow positive. I think they did mention it in the business update. They do have expectations of being free cash flow positive. I will believe that when I see it. And this company wants to become free cash flow positive and profitable. That's the only way this downtrend will come to an end, unless interest rates fall from 5% down to 1%. That's the only way this company will be helped if they don't become profitable. Now on to two iron ore plays. I've already mentioned that it seems like most of the money is going into Fortescue, maybe BHP and Rio Tinto, because Fortescue's share price is up past $25. Now, if we look at the weekly chart, maybe once before, very briefly, back in 2021, did the share price of this company get above $25 when the price of iron ore was well above $200. So for some reason, Fortescue, or people just love Fortescue at this point in time. This is actually a good looking chart right now, but again, it's on the back of iron ore prices. Now, I'm going to show you Fenix. So just remember this chart looks really good. And now let's have a look at Fenix. And Fenix will benefit from my rising iron ore prices, but no one cares about Fenix right now. And so this is an opportunity to take advantage of an iron ore play where the share price is not rising. It hasn't risen much from the recent lows, up from 21 cents to 23.5 cents. I have been a shareholder of this company. I sold to buy Mount Gibson, and I am thinking that if iron ore remains where it is right now or even increases, this could be a really good value play. The dividend yield 8.5%. I'm pretty sure they did decrease the dividends. A market cap 163 million. So I was a little bit surprised that Phoenix Resources share price hasn't gone on a run. I haven't looked at this chart for a week, and I just expected its share price to be up to, say, 25, maybe even 26 cents. Now on to Technology One. This is not a trading possibility. This company released their full-year results, or maybe the half-year results, I forget which one, on November 22, 2022, last year. So Technology One should release their results in the coming week, the trading week. Share price has gone on a nice little rally up from a nice little support area at $14.50. I have heard a couple of analysts say they expect Technology One to beat expectations. So there is a possibility that Technology One's share price could rise on that. And I am thinking, because of what I've heard, possibility of beating expectations, doesn't mean they will, that I might just, and this is the company I want to own for the long term. So this is a possibility of a company I'll put into my long-term portfolio. And another reason why is because I bought Technology One many, many years ago, and then I sold it as a profit. And this is a company I should not have sold. This is a beautiful, high-quality company. You are paying for this, a premium to the share price. Price earnings ratio 54.4. But look at this. This is a weekly chart. Why did I sell out of this sort of chart? Why? At that point in time when I did sell, I was probably paying less attention to charts and just looking at valuation. And if I'd paid a little bit more attention to charts, I never would have sold out of this company. Silly, silly decisions. And that's why I also believe technical analysis can be very helpful for long-term investors. Instead of just looking at value and ignoring the chart, just look at the chart also. Now, if the share price or the chart of Technology One was looking bearish and I thought it was overvalued, maybe I could have taken some profits. But anyway, P/E ratio 54 is expensive. I did not know, according to TradingView, car sales is called Car Group. I did not know car sales had changed their name to Car Group. Anyway, this is, actually, just look at the weekly chart. This is another beautiful looking chart, just off the weekly chart. You get these little dips, buy the dip situation. So maybe now is not the time to buy Car Group because the share price of this company has gone on a nice run, beautiful uptrend, going sideways now, but the share price did drop 3 or 4.4% on Friday. Wondering why it did drop. Is this a buy the dip opportunity? They did release a bullish financial results on the 14th of August. Share price rose 7% on the day. I should have taken a position. I did put this company onto my to buy list, and the next few days the share price just went sideways. A lot of volatility in those days, but we didn't see any selling. That was a good sign, and the share price has gone higher from there. So Car Group is a company I've had on my watch list for a while now, and I'm just thinking. It says price earnings ratio 16.3. It's not 16.3, TradingView. What are you talking about? It says the profit last year was 645.6 million, increasing from 160 million, even though the revenue was 781 million. Maybe there was a one-off profit, which makes the price earnings ratio seem way smaller than it is. If this company's price or true price earnings ratio was 16.3, I'd be all in on Car Group. A company I know nothing about, Clarity Pharmaceuticals, market cap 314 million. Don't think this company has any revenue, no revenue, but the market likes it. This is a nice looking chart. Nice little tip. Share price has gone on a rally. If the share price gets above $1.28, that would be a bullish move, and this company would be reaching a new high. So Clarity Pharmaceuticals, CU6, no idea what they do. Clinical stage radiopharmaceutical company. And the main reason I put this on my watch list is just the chart, a nice uptrend. There's not many companies on the ASX where the share price is in a nice uptrend. The same can be said for this company, Westgold Resources. There's not many gold companies on the ASX where the chart is in a nice uptrend. Red 5 is one, Westgold is another. There's a few other ones as well. A lot of companies or gold companies are in downtrends. A few others, it's just share price going sideways. I don't know anything about Westgold Resources. Markup $1 billion, price earnings ratio 96.2. But this is a nice looking chart. Share price has gone up from a low of about 70 cents up to $2.10, and that's in about a year. So this is a triple bagger or three bagger for shareholders over the past year. Nice looking chart for Westgold Resources. I probably should do some research on this company. Now onto Cobram Estate Olives. So this has been on my watch list for a while now because a possible shift in sentiment, a possible change in the trend in the share price, and the share price needs to get to about $1.45 for me to confirm that. Says price earnings ratio 79.2. It's fairly, if that is a true price earnings ratio, that is fairly high. So another company I'll probably have to do a little bit of research on, but at least I know what this company does, just like Westgold. I know what they do, but I like to do a little bit more research. But Cobram Estates could be just a trading position, a breakout. It would be really good if the company released a good financial news right now, because that would confirm a breakout if the share price rallies on that. Another company, Clearview Wealth. This is just like Cobram, whatever it's called, Olives. This is a potential breakout. You can see the share price trying to move an uptrend. Share price now at a 1-year high for Clearview Wealth. Market 361 million. Company is profitable, dividend yield, price earnings ratio 21.2. Probably a financial services company. Says it's a finance investment manager. What does it do? Non-operating holding company which engages in the provision of wealth management. So another company I don't know much about. Probably should do research just because of the chart. Now on to Karoon Energy, one of the oil plays. I was thinking of maybe trading this when the share price was around about $2.50 because the share price had moved into an uptrend. Remember, that coincided where the oil prices was on a nice little uptrend path. Share price has collapsed because the company did a massive acquisition. They've made an acquisition of a percentage play in the Gulf of Mexico oil field or something, and they did a couple raising at $2.05. That's why the share price fell. Now, it didn't fall on the 15th of November because of capital raising. It was because they didn't go into trading halt before news leaked of this acquisition and the trading halt and the capital raising. That's why the share price fell 10.4% on that day. Karoon Energy should get a query from the ASX because of that, because there was maybe not loose lips, but I'm pretty sure it was in the newspapers about this before the company went into a trading halt, and then the share price closed at $2.05 at the exact price of the capital raising. I was thinking of potentially just taking a position in this company because of where the share price is, and if this is a really good acquisition, possible value for Karoon Energy at these prices. But the question I do have, is this a good acquisition? It's a major question you have to ask yourself whenever a company does a massive acquisition like Karoon Energy. And the last two companies are the two companies I added to this video. First one is Stealth Global. What's going on with this company? Really interesting run in the last week and a half. Share price on the 15th, we'll say share price on the 7th of November, was that Melbourne Cup Day? Closed at 16.5 cents, around 16 cents. Share price now 24 cents. So this company's share price has increased 50% in a week and a half. Not massive volume. I would like to see massive volume coming in. The other thing I'd like to see when a share price goes on this run is some reason behind it, some catalyst, like good financial news from the company. So maybe there was a recommendation from fund manager or something like that, which has caused this little rally in the share price. I just don't know. I'm trying to wrap my head around it. I am now up, was it 50% in this company? I'm thinking maybe I should take profits in Stealth Global. I do think there's value. Markup 24 million. This company is going to be profitable. They are growing. They have good expectations in the future. And if they meet those expectations, even though the profit margins of this company are fairly low, if they meet their, whatever it is, financial year 25 or financial year 26 expectations, this company is pretty cheap right now. Now on to Gentrack. And I mentioned there is potential, I think, there where integrated research becomes Gentrack. And this is a beautiful looking chart. And I bought Gentrack way back here. sometime in mid-2020 when the share price was $1.20. And I waited a long time. I waited 2.5 years for the breakout of this company. So I played this wrong. What I should have done is have this on my watch list and just wait for the breakout. Wait for the turnaround story to unfold. And that turnaround story started in November last year. So we're talking about 1 year ago. And you can see the breakout. This is a beautiful textbook breakout. Share price increased on the 30th of November 2022. Share price increased 19% on one day on pretty good volume. And look at the chart after that. That was a breakout. I should have been waiting for that day and then bought a position, and I've taken profits along the way. Now, if I did wait for that breakout, I probably would have bought in at $2.40. So double of what I bought in 2.5 years previously. But even though I would have bought in at a higher price, that was 2.5 years of money just sitting there doing nothing because the share price went sideways. Didn't really increase all that much. So that's 2.5 years where I could have put that $1.20 or whatever money I invested in this company at play, and I could have got a significant return on that money. I could have doubled that money or tripled that money. So it's all about the opportunity cost. Are you willing to wait a long term for the breakout? That's something I do have to think about now. Just wait for the breakout and then buy at a higher price than what you could have had, or just be willing to have that opportunity cost. So that's all I have for this video today, this portfolio and technical update. If you have any questions about any company as I've included in today's video or about my portfolio, just leave those in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.